Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday, the 4th of May 2020, and yesterday we published an important video, in fact, entitled The Truth About Gold Supply, Demand and Prices, and on Saturday our regular gold and silver weekly update, where we highlighted what happened to gold and silver prices last week, together with economic data to watch out for this coming week. Well, so far today, with the time being midday here in the United Kingdom, gold is up nearly $4 at $1,705, though it did touch $1,717 earlier, while silver is currently down 6 cents at $14.95, actually dipping as low as $14.74 just a couple of hours ago. Now the dollar index is up a little, 99.42, while European equity markets are broadly down. Today's video, though, is more about banks and globalization. As the global economic crisis worsens, we're beginning to see a shift in the attitudes of major lending banks, away from international finance and investment to focusing more on businesses at home. This is, of course, understandable, especially as individual governments are in effect forcing their domestic bank regimes to support their own central bank QE policies and their own fiscal policies. What this in effect means is that banks are now turning inward in terms of investment, and we shall briefly look at an article published today by Bloomberg on this very subject. Bloomberg Article dated May 4th, 2020. Heading: Global Banks Turn Inward with Pandemic Upending Priorities. The coronavirus pandemic spurred a turn towards nationalism around the world. Now, banks are in the vanguard of the movement, central to government rescue efforts in the face of the worst recession since the Great Depression. Intesa Sanpaolo SPA, headquartered in Milan, is reinforcing an Italy-first lending policy. Beijing-based Bank of China is retreating to its home market after a big push into the Middle East. In Frankfurt, Deutsche Bank AG put Indian expansion plans on hold while throwing resources at Germany. Bank of America, with its head office in Charlotte, North Carolina, is among several US institutions being more selective in their European lending. A renewed national focus could choke off fledgling expansion by banks that were just rebuilding their global reach after the 2008 financial crisis abruptly ended an era of exuberance. A domestic pivot also will lock many lenders into markets where competition is intense and growth opportunities limited. Banks were beginning to expand internationally when the virus hit. While the bank's change of emphasis was spurred by the health crisis, it follows a tide of nationalism reflected in political events from Brexit to President Donald Trump's America First policy to a debate over the future of the European Union. That nationalism in turn may be sharpened by the pandemic. Curbs on overseas travel, state control of some key companies, and trillions of dollars of emergency loans point to a strong government role in economies for years to come. Quote, "We expect to see a strong focus of banks on their domestic market," said Alexandra Anek, a fund manager at Union Investment in Frankfurt, who focuses on financial services companies. The state guarantees for loans are organized on a national basis, and banks will be serving their corporates at home first and foremost, unquote. The new priorities affect banks at different points on the arc of international expansion. The three biggest US institutions, a handful of European ones, and most Japanese lenders have extended their international reach in the last decade and probably will continue to do so after this crisis. JP Morgan Chase & Co., Citigroup Inc., and Bank of America Corp. say their global ambitions haven't been dented by the pandemic. BNP Paribas SA, on the other hand, is the only European bank to have resisted shrinking its US presence since the last crisis. HSBC Holdings plc is increasing its focus on Asia. Japanese banks need to keep lending overseas because interest margins at home are almost non-existent. How many global European banks do we still have? Said Jan Schildbach, head of research for banking and financial markets at Deutsche Bank AG in Frankfurt. Quote, most hadn't fully recovered from the last crisis. This one will just make their global ambitions harder to rebuild if they ever can. End quote. Many executives say their credit decisions reflect greater caution everywhere, rather than a deliberate decision to cut exposure to foreign markets. The US banks and several European counterparts have already raised provisions to the highest level since the financial crisis. That's eaten into their profitability, and some say worse is yet to come. US banks have been more conservative, provisioning multiple times the levels of their European peers to date, based on the relative size of loan books. Bank executives are keen to point out, however, that the crisis presents new expansion opportunities. Citigroup's investment banking co-head, Manola Falco, said retrenchment by the Europeans will thin out global competitors. Deutsche Bank's head of corporate banking, Stefan Hoops, said the institution recently extended more credit in the US to companies including Disney as domestic rivals turn cautious. His boss, Chief Executive Officer Christian Sewing, said he'll jump in where rivals pull back. As banks face constraints on capital and demand for more funds across the world, they'll need to choose places where that limited capital can earn a better return. Many countries in Europe, with extremely low interest rates and slim margins, are unlikely to be at the top of priority lists of big international banks. There's another reason rooted in the great financial crisis that banks are eager to embrace their roles as part of the national solution to the current turmoil. The 2008 meltdown stemmed from banks' poor lending and investment practices, yet they raked in hundreds of billions of dollars in taxpayer bailouts, while the trouble they helped foment plunged millions of people into foreclosures and unemployment. This time around, governments are relying on banks to funnel trillions of dollars in credit to crisis-hit companies. They vet applications, distribute the money, and manage loans through their life cycle. In most cases, they also retain a chunk of the risk. There is a voracious demand for this aid, and banks have set up teams numbering in the thousands to cope. In Europe, given the crucial role large banks will play in propping up domestic economies, even when the crisis is over, they will be very reluctant for some time to take on new risks that are not directly related to helping their home markets in a post-COVID-19 world, said Sam Theodore, a managing director at Scope Group's research unit. At margin, the large European banks will become less international, at least for a while. End of article. We can see from this article that the trend is in place, and whilst a few of the major international banks believe they may be able to fill the gaps that other banks now create, the trend is effectively towards domestic lending and investment support. Now, one may ask, why is this important or even relevant? Well, the answer to some extent is the effect of globalization, where investing and expanding one's operations overseas has arguably led to greater economic growth and a wider spread of wealth, particularly to those nations which lacked it originally. China and India and other emerging market economies spring to mind. Now, that said, there is also the argument that this pace of globalization will now come to an end, and the ramifications of such moves are quite extensive. Almost a month ago, an article was published by Reuters on this very subject. So let's take a look. Reuters article dated April 2nd, 2020. What happens when globalization fails? Past cycles of globalization have shown themselves vulnerable to sudden shocks. The First World War brought the Victorian free trade era to a shuddering halt. Trade picked up after the conflict, but the 1929 crash was followed by beggar thy neighbour tariffs and another violent contraction in world trade. The fallout from the Lehman Brothers crisis damaged faith in globalization. The COVID-19 pandemic could well be a harder blow. A world that turns increasingly inward will look very different to the one we know. Protectionist pressures tend to increase at times when economic growth weakens. After the 2008 financial crisis, several countries, including China, sought to bolster their own economies with subsidies for exporters. By the middle of the last decade, trade restrictions affected a greater share of world trade than in the 1930s, according to Global Trade Alert. In 2015, world trade volume started to decline. Most trade restrictions at the time were below the radar. But since the arrival of Donald Trump to the White House, protectionism has become more overt. Since early 2017, thousands of new trade distortions have been introduced. The US-China tariff war accounts for less than a quarter of recent anti-trade measures, estimates Simon Evenet, Professor of International Trade and Economic Development at Switzerland's University of St. Gallen. Still, the American president's preference for conducting policy on Twitter has taken a toll. Last October, the International Monetary Fund warned that tariffs and uncertainty about trade policy were discouraging new investment and dampening the prospects for the global economy. At this critical juncture for globalization, COVID-19 emerged in Wuhan. The coronavirus pandemic threatens globalization in several ways. First, it has exposed the fragility of cross-border supply chains. In recent years, producers have taken advantage of cheap dollar funding for trade credit to lengthen their supply chains, often incorporating several countries. These tend to be more efficient in terms of cost, but are also more vulnerable. When Beijing tried to halt the spread of the epidemic in January, many Chinese factories were shuttered. Apple had problems sourcing parts for its iPhones. It soon became clear that many Western firms lacked an adequate understanding of their supply chains. Global trade links suddenly appeared to be as complex, interconnected, and vulnerable to unexpected shocks as the financial world showed itself to be when the subprime crisis emerged. The pandemic's threat to world trade took a more insidious turn last month. Back in January, Beijing stopped the export of certain medical supplies, such as face masks, including those produced by foreign manufacturers. As the coronavirus spread across Europe, export restrictions proliferated almost as fast as the virus itself. Since the start of the year, more than 50 governments have imposed export curbs on medical supplies, according to Global Trade Alert's count. Germany stopped the export of 240,000 masks to Switzerland. France prevented Volney from fulfilling its contract with Britain's health service to supply millions of masks. India, a major producer of generic medicines, imposed a range of export restrictions on medical supplies and drugs, including fever reducer paracetamol. The European Union, which produces half the world's ventilators, restricted their export. Of the world's major economies, only the United States and Australia have maintained free trade in medical supplies. Beggar thy neighbour trade policies have become sicken thy neighbour, says St. Gallen's Evenet. Panicked reactions to the pandemic bring short-term relief at lasting cost. Companies may be reluctant to invest for export markets if those markets are shut off at whim. More importantly, export bans foster bitterness between trading partners. Deprived of medical supplies from Germany, Italy, and Serbia turned to China for relief. Medical export restrictions succor nationalists who argue in favour of self-sufficiency in manufacturing. White House Trade Consigliere Peter Navarro states that American dependence on China for key medical supplies and drugs is a wake-up call. What might the world look like when the pandemic passes? For a start, supply chains are likely to become shorter and more robust. Cross-border manufacturing will take on a geopolitical aspect as managers question whether production is located in trusted countries. Moves to repatriate manufacturing, especially in key areas such as healthcare, will receive a fresh impetus. The age of multinational oligopolies is coming to an end. Takeover authorities will pay less attention to consumer prices when considering mergers and more attention to other matters such as competition and security. If China becomes the scapegoat for the pandemic, as is likely, it can no longer serve as the workshop of the world. British politicians are already calling for a reassessment of their government's decision to allow Huawei Technologies to provide telecoms equipment in the United Kingdom. Some of the macroeconomic consequences that follow a turn in the globalization cycle are foreseeable. The disinflationary forces unleashed by the era of free trade will come to an end. When trading links frayed at the close of the 19th century, the great Victorian bond bull market came to an end. The current bond bull market, nearly 4 decades old, will be replaced by a multi-year bear market. As interest rates rise, a higher discount rate will be applied. Stocks and houses, both of which will trade in the future at lower valuations. No longer able to outsource manufacturing to the cheapest geographies, manufacturing costs will rise. Profits will decline, and labour's share of national income will rise. The geopolitical consequences of an end to globalisation are more fraught. As the history of the 1930s shows, the struggle for raw materials in a multipolar world can become a casus belli. For years, Beijing has been pursuing a 1930s-style autarky, tying up supplies of commodities from various countries, such as Venezuela, with loans from the China Development Bank. More recently, Beijing's Belt and Road Initiative has increased its number of client states. At the same time, the People's Republic has reduced the share of foreign components in domestic manufacturing. China may, unwittingly, have provided the catalyst for this crisis, but if globalization fails, it will enjoy its head start. End of article. Now, we're not going to state that we agree with all aspects contained within the Reuters article, but we do agree with its general tenor. What many of us who follow such things have to ask, though, is to what extent will any restraints on globalization have on our domestic economies and companies? Will this lead to lower levels of growth and lower growth expectations? Will this lead to lower standards of living, as higher prices will inevitably filter through, as one is less able to take advantage of low employment cost countries? Will inflation raise its head as prices become more expensive? And how will policymakers deal with this when one considers the level of current national debt, let alone what it might be like in a few years from now? The traditional course, we may remember, of dealing with rising inflation is raising interest rates, which may, due to the level of national debt, become almost impossible. These are questions, quite frankly, many of us will have little influence over. What we do have, though, is some influence over is how we ourselves prepare for this. And there is little doubt in our minds that if commodity prices rise, then those of us already holding reasonable levels of such commodities, such as gold and silver, will be better placed. Now, this may take a few years to filter through, but this is also why we see any setbacks in precious metal prices to be a good opportunity for acquisition, not panic buying at enormous premiums, as some have done over the last month or so, and will very soon regret doing so, certainly short term, but gentle, regular acquisitions, taking advantages of dips as and when they occur. What do you think? Is globalisation dead or just stalled? What effect will current financial policies have on our domestic economies, and who, in your view, will benefit the most? Do share your thoughts. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting that we update our Richard and Greg channel every few days, and if you haven't already done so, please subscribe to that one too. And finally, just a brief note that due to various other pressures, I've not been as actively involved on Discord as I would have liked to have been over the last couple of months. This will now gradually change, as you will see Greg and myself and other members of our team become much more engaged. We know that many of our Inner Sanctum members and subscribers here are members of Discord, and we hope we will be able to resume the service and our interaction much more effectively from now onwards. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.